If you've ever looked at investing in a segregated fund, you've probably seen that huge stack of paperwork.
Oh, yeah. It looks like pure compliance.
Exactly.
Yeah.
But hidden inside that dense agent checklist are the few key details that can really define your financial future. So today, we're cracking that code.
That's the mission.
We're going to decode that mandatory recommendation guide and turn all that bureaucracy into, well, a personal roadmap for you.
And that's really what it is. The sources we looked at show the process is, the agent analyzes your needs, presents a recommendation for a specific fund.
And has to back it up with a solid reason.
Right. But the key is that all that paperwork, it isn't just for the regulator. It's for you. It's so you understand exactly what you're getting into.
And you, the client,
Yeah.
always make the final call. The agent is the guide, but you're the one signing on the dotted line.
That's the bottom line. And there's a really crucial rule to protect you.
Okay.
If you come back, say, 6 months later to invest more, the agent has to do a completely fresh assessment.
They can't just assume nothing's changed.
Never. Every single investment decision needs its own due diligence.
Okay, so let's unpack this roadmap then. Every recommendation has to cover, what, 7 key things?
7 crucial elements: the fund itself, how your deposit works, the dollar value of the guarantees,
The risks, of course.
the risks, the MER, that all-important reset feature, and the specific maturity date. If any of that's missing, you need to be asking why. So let's start at the beginning. The foundation: fund matching and deposits.
Okay.
The recommendation has to name the insurer, say XYZ Life, and the actual fund type. Is it an equity fund, a bond fund, an income fund?
You need to know what you're actually investing in.
You do. You have to understand it's a pooled investment, but it's concentrated by that specific type.
So why is that concentration so important? It sounds a bit technical.
Well, it matters for risk. A pooled fund means you're diversified across a lot of different stocks or bonds, which is good.
Right. You're not putting all your eggs in one company's basket.
Exactly. But if it's all concentrated in, say, Canadian equity, the whole pool is still subject to the ups and downs of the Canadian stock market. It helps you align the product with your risk tolerance.
Got it. Now, our sources talk a lot about this like-to-like rule for comparisons.
Yes, and this is critical. An agent has to compare apples to apples. If they're showing you performance or fees, they have to compare a balanced income fund to another balanced income fund.
Not to some high-flying tech fund.
No, that would be completely misleading. And if they recommend a mix like one bond fund and one equity fund, they have to give you a clear written reason for why each one fits your goals.
Okay, let's talk about the money, the deposit, or the premium.
Yeah.
The agent shouldn't be pushing for more than you're comfortable with, right?
Not at all.
Yeah.
They have to follow your lead, and it should align with the needs analysis they just did. And remember, funds have minimums, sometimes maximums, too.
So once you put the money in, it gets converted into units.
Right, based on the net asset value, or the NAV. There's a great example in the source material. A $10,000 deposit into Fund A with a NAV of $12.89 gets you about 775 units.
Okay.
But that same $10,000 into Fund B with a lower NAV of 1116 gets you almost 900 units.
So you feel like you're getting more with Fund B. A bit of a psychological trick, maybe?
It can feel that way, but it tells you absolutely nothing about the quality of the fund.
It's just a number.
It's just the price on that day, a snapshot. It's not an indicator of performance at all.
Okay, what about making regular deposits, say every month? A lump sum is easy, one deposit, one guarantee. But this sounds more complex.
It adds a significant layer of complexity. Periodic deposits, they often create a whole series of guarantees.
A series.
Yeah, look at the example of Chris. He puts in $250 a month. Over a year, that's 12 separate deposits.
So each one of those has its own maturity date.
Each one. Each of those 12 deposits is guaranteed on its own separate date. You could have maturity dates spanning decades.
Wow, that makes long-term planning really difficult if it's not laid out clearly from the start.
It does. And before we move on, we have to touch on transfers. This is where people can get caught in tax traps.
Right.
So moving registered money, like from one RRSP to another, is simple. It just has to stay registered. The tricky part is moving non-registered money into a registered account.
So if I take $20,000 cash and put it into my TFSA,
That counts as a brand new $20,000 contribution for that year.
and I better have the room for it.
You absolutely must. If you don't, you're looking at over-contribution penalties from the government, and they can be pretty steep.
All right, let's pivot to the main event. The thing that makes these funds unique. The guarantees.
This is the absolute core difference from a mutual fund. Segregated funds automatically give you a 75 or 100% guarantee.
On both maturity and death.
Both. And for a lot of investors, that protection, it lets them take on a bit more risk, maybe in equities, than they would otherwise.
And the agent has to spell that out in dollars and cents.
They must. If you deposit $50,000 with a 75% guarantee, they have to state clearly $37,500 is guaranteed at maturity. That number makes it real.
And the upside is unlimited. You're not capped. If the fund does great, you get the higher market value.
Exactly. The guarantee is a floor, not a ceiling. But, and this is a huge but.
Here's the catch.
Here's the catch. If you surrender the contract, cash it out before that maturity date, you lose the guarantee completely.
So you just get whatever the market value is at that moment.
Which could be less than you put in. You're basically forfeiting the main reason you bought the product.
And what if you just take a partial withdrawal?
The guarantee percentage stays the same, but the dollar value is reduced. And the agent has to immediately tell you what that new lower dollar guarantee is.
Okay, so that maturity date itself, how long are we talking?
Usually it's at least 10 years from the deposit date. It can go all the way up to the annuitant's 100th birthday, but the agent has to use actual dates.
No vague timelines.
None. A deposit on May 16th, 2024 matures on May 16th, 2034. It has to be that specific.
And I've heard that if you want that 100% guarantee, the gold-plated version, you might have to lock in for longer.
That's a very common trade-off. To get that full 100% back, you might be looking at a 15-year term instead of 10.
So your 2034 date just became 2039.
And that 5-year difference can be a massive deal, especially if you're trying to time your retirement. So, while the guarantees are great for peace of mind, we have to talk about risk.
Right, because the money is still invested in the market.
It is, which is why every contract has that mandatory bold warning right at the top.
The one that says any amount is invested at the risk of the contract holder and may increase or decrease in value. It's a bit of a contradiction, isn't it?
It's the tension you have to live with. Your principal is protected way down the road at maturity, but in the meantime, the value is going to fluctuate.
And the risk is usually shown on some kind of scale.
Yep, a 5 or 6 band scale. It averages out the risk of everything inside the fund. But different funds carry very different kinds of risk.
For sure. A bond fund isn't the same as an equity fund.
Not at all. A bond fund is really sensitive to interest rate changes. An equity fund has that broader market risk. The agent's job is to match the specific type of risk in the product to your personal tolerance for it.
Okay, this brings us to what might be the most important and maybe most misunderstood feature, the reset.
Ah, yes. This is the definition of a double-edged sword.
So what is it exactly?
The reset lets you lock in any market growth. So if your $10,000 investment grows to $12,000, you can reset the guarantee base up to that new higher number.
So your new floor becomes $12,000.
Your new floor is $12,000. If the market tanks after that, you're still guaranteed the $12,000 at maturity. If the market goes down, you just don't use the feature.
That sounds amazing. Just a pure win. What's the trade-off?
There are 2 big ones, and they can mess up your retirement plan if you're not careful. First, using a reset almost always extends your maturity date. And second, that flexibility isn't free. It's usually paid for through a higher management expense ratio, a higher BAT.
And the example of Nasir and Farah in the source material just perfectly illustrates that risk.
It's a stunning example. So Nasir has a $5,000 contract. His maturity date is April 23rd, 2030.
Yeah. He picked that date for a reason.
A very specific reason. He was planning to use that money to delay taking his government pension benefits to get a bigger payout later on.
Common strategy.
Very. But his contract had an automatic reset every 2 years.
So when the market did well,
Boom! The reset triggered. It locked in his growth, which is great, but it automatically pushed his maturity date out by 2 years to 2032.
oh wow.
So now Nasir might have to start taking his pension benefits sooner and at a lower rate, all because his contract automatically got longer.
That's not just a minor date change. That directly impacts his retirement income for the rest of his life.
It's a huge strategic choice that was hidden in the fine print. They had to decide if that enhanced guarantee was worth risking his entire pension strategy. We should also just mention income riders, like a GMWB.
Guaranteed minimum withdrawal benefit.
Right. They can guarantee an income stream for life. An agent has to explain them, but they aren't super common, so comparing them is tough.
Okay, let's get to the bottom line.
Ah.
Costs and disclosure. Starting with the management expense ratio, the MER. This is probably the most important number on the page.
It's the hidden toll booth on your investment journey, I like to say. It's the percentage of all the expenses management, operating costs, taxes, the cost of the guarantee itself.
And the key thing to remember is that it's charged every single year, no matter what.
Whether the fund makes money or loses money, that MER comes off the top.
And this is where new investors get confused. The performance number you see reported is after the MER has already been taken out.
That's right. So if a fund says it returned 5%, but it has a high, say, 3.5% MER, the fund actually had to earn 8.5%.
You got 5, the manager kept 3.5.
Exactly. The Roberta example in our sources really clarifies this.
Right.
Fund A has a 3.5% MER. Fund B has a 1.5% MER. They both report a 5% return to her.
So she gets the same amount of money.
She does. But Fund A had to work a lot harder. It had to generate an 8.5% return just to give her that 5%. Fund B only needed to make 6.5.
But I guess a higher MER can be justified sometimes.
No, absolutely. If Fund A is so good that it reports a 6.2% return, well, its real return was 9.7%. Roberta is happy to pay that higher MER because her net return is better. The agent has to be able to walk you through that comparison.
Before we get to the disclosure docs, what about other fees, penalties, and charges?
Yes, they have to be disclosed. These are long-term contracts. Cashing out early can trigger account closing fees.
And what about switching funds?
That's a big one. Watch out for short-term trading fees. If you move your money around between funds too often, the insurer can hit you with pretty big charges to discourage it.
So what documents do I need to have in my hands before I even think about signing?
The agent has to go over the information folder, but the most important thing is the fund facts document.
That's the mandatory one.
It is. It's a short summary designed for easy comparison, and you must get it before you sign anything.
And for those who want to go deeper,
You can always ask for the financial statements. They're audited annually and show up to 5 years of detailed performance history.
and what are the key things to look for in those fund facts?
I'd start with the total value of the fund. A bigger fund can sometimes mean a lower MER.
Economies of scale.
Exactly.
Right.
Then look at the date of inception. A fund with a long track record has been through different market cycles, which can be comforting for more conservative investors.
In the performance data, we know it's not a crystal ball.
Never. But it shows you year-by-year returns, so you get a feel for how bumpy the ride has been.
Anything else?
I'd check the fund manager's tenure. You know, great performance doesn't mean much if the person responsible just left. And finally, the portfolio turnover rate.
How often they're buying and selling?
Right. High turnover can drive up trading costs, and the MER, a low number, suggests more of a steady buy and hold strategy.
So this deep dive has really shown that understanding the recommendation guide is all about grasping the strategic trade-offs.
It is.
The key is balancing the comfort you get from the guarantees against the actual risk profile and seeing how that deceptively simple reset feature can totally change your long-term plan.
That's right. And we've covered that agents must also detail things like sales charge options, how taxes work on withdrawals, and any penalties, all while discouraging you from cashing out early.
And they have to justify their choice of fund, comparing MERS and guarantees.
Which really brings us back to the final question for you, the investor. If the agent is recommending the premium 100% guarantee over the standard 75, and that choice is going to cost you, say, an extra 1.5% in MR every single year,
You have to ask a deeper question.
you do. You have to ask, how specifically do you justify that increased cost against the growth I'm potentially giving up?
Is that extra protection really worth sacrificing years of compounding returns?
Exactly. You need to challenge them on that relationship between cost and protection.
That is a powerful financial question to think about. Thank you for joining us for this deep dive. We'll see you next time.